Key ideas in quantitative finance. The probability of default. Where do we start when we discuss default? Well, we should start with credit, and we should start with definition of credit. The word credit, in fact, which is a noun, is defined as the ability of a customer to obtain goods or services before payment based on the trust that payment will be made in the future. It comes from the Latin creditum, that in turn comes from credere, to believe or to trust. This is the definition of the Oxford English Dictionary of the word credit. And in fact, it's crucial because everything we do when we consider credits, and these days it is very important after the financial crisis to consider credit in all its forms, in particular counterparty credit risk, which is something that we didn't do before the financial crisis. And this is linked directly to this definition, these few words, because words are very powerful, and here we can see that these words describe what we need to do, what we need to take care of. The ability of a customer to obtain goods or services before payment based on the trust that payment will be made in the future. We have two moments in time, when we receive the goods and when payment will be done. This difference in time is where anything could happen, and this is where default or bankruptcy could happen, and therefore we need to estimate what is the probability that this thing could happen, and that is the probability of default. But of course, this is something that has always happened when there is money involved, when there are goods and there's credit. We have the possibility that default, that non-payment could happen. Indeed, the oldest regulations about interest rates, forgiveness of debt, and extension of credit come from the Code of Hammurabi from 1754 before Christ. At the time, payments were done through a local temple and were also done through written draft for deposits. The story of credit then takes us fast forward into the future to March 24, 1989. That day, something happened. And what happened was that this large oil tanker, the Exxon Valdez, ran aground in Alaska. The bad news, well, for Exxon and for the ecosystem and from everyone else, is that this oil tanker was full of oil. And this was spilled in the waters in the North Pacific. And it was a large ecological catastrophe. Catastrophe for nature, but also catastrophe in financial terms, a catastrophe for Exxon, which 5 years later found itself almost at the point of default. At the point of default because it had to pay close to $5 billion in punitive damages because of the Exxon Valdez spill. $5 billion. This $5 billion will be too much for the pockets of Exxon, and they will have to find a way to obtain a credit line to pay for these things. JP Morgan, the bankers of Exxon, had an idea, and in particular, Blythe Masters, an investment banker at JP Morgan, had an idea that will revolutionize the financial markets, in particular the credit risk markets. The idea was simple. The idea was to sell the credit risk of a loan or of a credit line that JP Morgan will give Exxon. They will sell this risk to a third party, in that case, in 1984, to the European Bank for Reconstruction and Development, who will act as a protection agent in this operation. So Exxon will have this opening of the credit line with JP Morgan, will give them the money, Exxon will be able to pay the damages, and in case something would go wrong, the European Bank for Reconstruction and Development will enter into the scenario and will pay what Exxon will not pay. Or if Exxon will go into default, actually it will pay the rest of the credit line. But of course, this will not be for free. They will charge a fee, and this fee is known now as the premium for the credit risk they are taking on. This operation developed into what is known now as the credit default swaps, as CDS. And the market increased dramatically in these last years. And of course, a lot of the financial crisis we say, and it can be traced to the use, or rather the misuse, of credit default swaps. And these have given them bad reputation. Nevertheless, they are very useful instruments. They do something quite unique in separating credit risk from an operation, a financial operation, which is very, very useful if we're doing hedging rather than speculation. It helps us to separate the credit risk from an operation, from a counterparty, from the possible default of a company or a country, and therefore protecting an investment that we may have in this company or country in the form of corporate bonds or sovereign bonds. CDS contracts can be regarded as an insurance contract against default. How do we model credit? Well, the question is how to model the default or the bankruptcy. And in fact, the answer is using survival analysis. So to model death, we model life, and then we regard default as death. And indeed, survival analysis is based on some simple mathematical formulas, such as this exponential function that describes the survival probability of a company or of a bank and how this decreases with time. The probability today is 100, but in the future it will be less. And how this changes is regulated, is controlled by a parameter called lambda, which is the hazard rate. Once we describe the survival probability of a company or a country, then we can describe also the default probability. So what are the chances that this company or this country might go in default? And how we do that? We do it by simply computing the survival probability up to a point, in this case T1, and then computing the survival probability to the next time point, in this case T2, and the difference between these survival probabilities must necessarily be the probability of default in that period in the future, that is between T1 and T2.